You wake up, you check your bank app, your paycheck hit. Nice. You tap your card for coffee. You Venmo your friend. You maybe owe a little on your credit card. All normal. But here's the thing. Banks are not just friendly money storage lockers. They are businesses, extremely profitable businesses. And the core concept you need to understand is this. Banks make money by using your money, not in a shady way, in a structured, regulated, very intentional way. Once you understand how banks actually earn, you'll never look at your account the same again. Let's break it down. Running example today, you, your $3,000, and your slightly irresponsible gym membership you never canceled. The core business. At the simplest level, a bank does two things. 1, takes deposits. 2, makes loans. That's it. You deposit $3,000. Your neighbor takes a $300,000 mortgage. The bank sits in the middle. This model is called financial intermediation, which just means connecting savers and borrowers. You give them money to hold, they lend that money out at higher rates. And the difference between what they earn and what they pay you, that's the engine. Here's the key word: net interest margin. Sounds fancy. It's not. It's just interest they earn on loans minus interest they pay on deposits. If they pay you 0.5% on your savings account, but charge someone else 6% on a loan, that gap is their spread. Of course, it's more complex in real life. Rates change, banks borrow from other places too, but the core idea stays the same. They borrow cheap, they lend expensive. Your $3,000 savings, it doesn't just sit there, it's working, mostly for them. Now let's talk about the side hustles. Credit cards. Credit cards are different from regular loans. They usually charge much higher interest rates than mortgages or car loans. That's because they're unsecured, meaning there's no house or car backing them up. If someone doesn't pay, the bank can't repossess your Uber Eats order. So they charge higher rates to compensate for risk. When you carry a balance and pay interest, that's revenue. When you pay late fees, that's revenue. When you swipe your card at the gym you barely attend, something else happens. Swipe fees. Every time you use your debit or credit card, the merchant pays a small percentage fee to process that transaction. Part of that fee goes to the card network, part goes to the bank. So when you buy a $12 protein shake, the store doesn't get the full $12. The bank earns a slice just for facilitating the payment. You feel like you're just tapping your phone, but behind the scenes, there's a payment ecosystem making money. Small cuts, millions of transactions, very large totals. Okay, that's deposits and cards. Fractional reserve. Banks do not keep all deposited money sitting in a vault. In modern banking systems, they keep a portion as reserves and lend out the rest. This is called fractional reserve banking. It doesn't mean they're reckless, it means banking works on trust in liquidity management. They know not everyone will withdraw money at the same time. So your $3,000 might help fund part of someone's car loan, which gets deposited somewhere else, which helps fund another loan. Money circulates. This is how banks expand credit in the economy. And yes, this is why bank runs are a big deal, because if everyone wants their money at once, the system strains. But under normal conditions, it works. Fees. Now let's talk about the boring but powerful stuff. Fees. Overdraft fees, ATM fees, account maintenance fees, foreign transaction fees. Individually, annoying. Collectively, massive revenue streams. Banks don't rely only on interest. Many large banks earn billions from non-interest income, which just means income not directly from lending. You forget to transfer money before a bill hits. Overdraft. That's revenue. You withdraw cash from a different ATM. Fee. Revenue. Small friction, big totals. Mortgages. Mortgages are long-term loans backed by property. Because they're secured, interest rates are usually lower than credit cards, but the loan amounts are huge.
Even a modest home loan means paying interest for years, sometimes decades. Banks either, 1, keep the loan and collect interest over time, or sell the loan to investors and earn fees for originating it. Either way, they earn. And remember your $3,000? It helps support lending like this indirectly through the system. Your savings is tiny alone, but pooled with thousands of others?
Risk. Here's something important. Banks don't just print profit. They take risk. Some borrowers don't repay. Loans default. Credit card balances go bad. Businesses fail. Banks have to estimate this risk carefully. That's why your credit score matters. It helps them predict how likely you are to repay. Higher risk equals higher interest. Lower risk equals lower interest. Not personal, statistical. Banks survive by pricing risk correctly. If they misjudge risk across millions of loans, that's when financial crises happen. So yes, they make money, but they're also managing risk constantly.
Liquidity. Banks must always have enough cash available to meet withdrawals. This is called liquidity. They can't just lock up all deposits in 30-year loans. They balance short-term deposits with long-term lending. It's like running a gym membership model. Most members don't show up at once, but if they all did, chaos. Banks rely on patterns of behavior, and most of us are very predictable.
Central banks. Commercial banks operate within a system influenced by central banks, like the Federal Reserve in the United States. Central banks set benchmark interest rates. When rates go up, loans become more expensive. Savings accounts may pay more. When rates go down, borrowing becomes cheaper. Banks adjust their rates based on these policy changes. So part of their profitability depends on the broader interest rate environment. They don't control everything. They operate within a framework.
Why your savings pays so little. Let's go back to your $3,000. You might be earning a small percentage in a basic savings account. Why so low? Because banks know most people value convenience and safety more than chasing yield. Your money is insured up to legal limits in the U.S. through the FDIC. It's liquid. You can access it any time. Higher returns usually require locking money up longer or taking risk. Banks compete for deposits, but they don't need to overpay if customers aren't leaving. It's supply and demand. Simple. Investment banking. Briefly. Some large banks also do investment banking. That includes helping companies issue stock or bonds, advising on mergers, and underwriting deals. This is fee-based business, not about your $3,000, more about corporations moving billions. Different division, same brand name. Why this matters. Okay, so what? Here's why this matters to you. If you understand how banks earn, you understand why interest rates on loans are high, why credit card debt is expensive, why fees exist, why your savings rate changes, why your credit score matters. You stop seeing the bank as a mysterious app. You see a business model. And when you understand the business model, you make smarter decisions, like paying credit cards in full to avoid interest, avoiding unnecessary fees, shopping for better savings rates, using debt strategically, not emotionally. Banks are not evil, they are rational, which means you should be too. Final takeaway. Banks make money because they sit between savers and borrowers and manage risk at scale. If you understand that, you stop playing the game blindly. Use the bank. Don't be used by the bank. And if this explained banking better than your high school economics class, hit subscribe, because next time we're breaking down something else the system quietly profits from.